We now need to prepare the deferred tax calculation of Pink Limited for the year ended 29 February 2020. As always, what is your plan of action? First, I will include a template, which is my deferred tax calculation template. Then I will refer to the information and I will add all of my assets, liabilities, line items. Now, important, we need to prepare this for 2022. Now, we will have to include 2021 as well as 2022 to be able to identify the movement, okay, which is not very clear, but I'm explaining this to you in the video, okay. Now, if you look at this is your deferred tax calculation template. Remember, you will have to determine your carrying amount as per your accounting rules, tax base, the tax rules. Remember our 4 rules that I have indicated to you. Let's quickly recap this. We have the tax base of an asset, and this will be the amount deductible in future. We have our tax base of our liability, which is the carrying amount minus the amount deductible in future. We have the tax base of revenue received in advance, which is the carrying amount minus the amount not deductible in future. And if our future economic benefits is not taxable, our carrying amount will equal our tax base. And this is your rules in terms of your tax base. Your temporary difference, either deductible or taxable, and then a deferred tax asset or liability. Now, at the bottom, you will identify that I've included 4 additional line items. When you identify the movement in your temporary difference, remember, closing balance minus opening balance, you need to identify which portion relates to your OCI, which portion relates to your profit and loss, and in lecture 2, your unused tax loss movement, and if there is a change in your tax rate. Right, now, we need to refer to our scenario and we need to identify all of our assets and liabilities to transfer to our deferred tax template. Now remember, we have read through this and I am now going to make use of Pink for you to be able to follow my discussion. We have land, factory building and office buildings. Important, these assets were purchased on 1 September 2019. Right, now this is our deferred tax calculation as per your solution. Please think with me and work with me through this. 2021, 2022. I will include my line items: land, factory building, office building. Factory building, office building, because we've sold the land in 2022. Right, now when you look at this, first I will include my carrying amount. Remember, this is in terms of our accounting rules. For land, land will be based on our cost model. Therefore, I include my cost price, the 1.7 million. Factory building, I need to calculate my carrying amount. The same in terms of my office building. Therefore, you will identify on the next page, I've included the calculations. Now, please listen carefully. Remember, our at acquisition date is 1 September 2019. Therefore, we have September, October, November, December, January, February for 6 months. We need to determine the carrying amount for 2021 and 2022. Therefore, when you look at the calculation, I have included the cost of our factory building, 4 million, office building, 2 million. Therefore, the 4 million times 2.5% times 6/12, and this will be depreciation for 2020 of 50,000. The depreciation for 2021 is 100,000 and 2022 100,000. Therefore, the carrying amount for 2021 will be 3.85 and 3.750 for 22. If you look at our carrying amount, I've transferred this 3.85 and 3.75. Same principle in terms of our office building, which you can work through. Okay, now if we look at our land for 2021, the tax base. Now think with me. On the right hand side, we have a few rules. Rule number 1, your tax base of your asset will be the amount deductible in future against future economic benefits. Therefore, if you think about the tax base of our land, when will the carrying amount be recovered? When they sell that asset. Therefore, when they sell that asset, the total cost price carrying amount will be recovered. Therefore, we have a carrying or tax base, guys, a tax base of 175,000. The day when they sell that land will be recovered, or that value. Okay. Then, if you look at our factory building tax base, we need to calculate the tax base. Therefore, calculation number 1, identify for 2020. Look at 2020, not apportioned. Do you see? 4 million times 5%, and this is 200,000. Therefore, our carrying amount in terms of our tax base for 2021 will be 3.6 and 3.4. We need to transfer this to our deferred tax calculation, 3.6 and 3.4. Next, our office building. Now, think about your principle. Sorry guys, let's make use of blue, my OCD. Right. Your tax base of your asset will be the amount deductible in future, right? But if you refer to the scenario, they've indicated to us, such does not allow any allowances on our office building. Therefore, is there anything that we will be able to deduct in future? No, nothing, because such does not allow any deductions. Therefore, we will not be able to deduct anything in future. And this will be an exemption in terms of paragraph 15. Such does not allow any deductions on the office building. Okay, now let's refer back to our scenario. We have transferred land, factory building, office buildings, and we have prepaid insurance premiums, right? Now, if we look at this, for accounting purposes, we have a balance in 2021 of 30,000, 2022 of 40,000. Therefore, in our deferred tax calculation, we need to add our prepaid insurance, 2022 prepaid insurance. For accounting, we have our 30,000 and 40,000, right? But what will the tax base be for 2021, 2022? If you look at the section that I've included here, section 23H of the income tax, limit the tax deductibility of prepaid expenses. However, since these expenses fall within the 100,000 exclusion provided, the total expense will be tax deductible in the financial year in which the expense was incurred. Now, let's just take this one step back. If you think about our journals, remember, we've indicated in the year in which they paid. Therefore, for 2021, debit our prepaid, credit our bank. Now, in the year where they've paid this 30,000, they were able to deduct this 30,000 for tax. You with me? Therefore, if we think about the tax base of an asset, will be the amount deductible in future? Nothing. Therefore, 0, because they've already deducted this. The same principle applies in terms of our prepaid insurance for 2022. Okay. Now, next step, our temporary difference. Remember, either a taxable or a deductible temporary difference. Now, land. Temporary difference is 0. Carrying amount minus tax base, and this is 0. Therefore, our deferred tax asset liability will be 0. Next line item, factory building. Our carrying amount, I just want to clean this a little bit. I need some space. Our carrying amount of our asset exceed the tax base. Do you see? 3.850 is greater than 3.6. Therefore, we have a temporary difference of 250,000 times this by our 28%, our manner of recovery in terms of our building. What are we going to do with this building? What is the purpose of the building? We're going to use the building to generate an income. Therefore, our carrying amount of the asset is greater than the tax base, and this will be a deferred tax liability. Office building. Important. In terms of our temporary difference, this will be exempt, and you can refer to paragraph 15, IAS 12, paragraph 15. Guys, it's a rule, you can study this one. Office building, it does come through quite regularly. Prepaid insurance. Again, our tax base is greater, our carrying amount. The carrying amount is greater than the tax base. Therefore, this will be a taxable temporary difference, and this will be a deferred tax liability. Next, 2022, factory building. We have 3750. This is greater than 3.4 million. Therefore, this is a taxable temporary difference, and we times this by 28%, and this is a deferred tax liability. Our office building, again, exempt, paragraph 15. Our prepaid insurance, it's an asset. Carrying amount is greater than the tax base, and it's a deferred tax liability. Now, let's just refer back to our scenario. Let's ensure that we have transferred all of the relevant details in terms of our deferred tax calculation. You normally scan through this, identify. Right, let's stop right here in terms of our check. They indicate to us that the minister announced that there's a change, a decrease from the 28% to the 27% for all financial years starting on or after 1 March 2022. Now, let's just recap, and I have mentioned this before. This is our timeline. Remember, we are looking at this from 2021 until 2022, February year end. Now, if you think about your current tax, our current tax relates to the income, the profit and loss for the period, right? Therefore, this was taxed based on the 28%, because the 28% is still applicable for this period. But our deferred tax is based on our statement of financial position method, and this is at year end. At year end. Remember, this is a future tax that we provide for. Therefore, in future, the tax rate will now be 27%. Therefore, if you look at our deferred tax calculation, the total deferred tax for 2021, is 78,400 deferred tax liability. The total deferred tax liability for 2022 is, sorry guys, it's this one here, deferred tax liability, 109,200. Look at the yellow, 109,200. Therefore, this will move from 78,400 to 109,200. But this 109,200 is based on 28% tax rate. In future, this tax rate will now be 27%. Therefore, we need to decrease this balance with 1%. 109,200 divided by our 28% times 1. And there will be a decrease of 3,900. Therefore, our final deferred tax liability at the end of 2022 will be 105,300. Now, let's just take this one step further, and this is an important section that I want you to ensure that you understand. You will remember that I've indicated to you that if the transaction has an effect on our equity, the tax will have an effect on our equity. Therefore, we have included this line item. Transaction through P&L, the tax will be through P&L. Unused tax losses, and now we have a tax rate change. Therefore, if you look at the movement from the one year to the next, look at this, guys. Our taxable temporary difference for 2021 is this 280,000, the orange taxable temporary difference. But for 2022, this will be the 390,000. Therefore, do you see that there is a movement in terms of our taxable temporary difference to the value of 110,000? There's a movement of 110,000. Therefore, the movement is 110,000. Then, there is a movement in our deferred tax liability from 78,400 increase to 109,200. Look at this. There is an increase. If your liability increase, we will credit the liability and debit. Look at our journal. We will credit our liability because this will increase, and debit our deferred tax in our profit and loss. Therefore, a portion of this movement, 30,800, which will be an increase. And then the standard indicates to us when there is a change in our tax rate, this 3,900, that we need to indicate this separately. Therefore, the 3,900, this will result in a decrease because we've provided at 28%, but now we only have to provide at 27%. Okay, then an important T account or general ledger transaction that I want you to ensure that you are familiar with and understand. If you look at this here at the bottom, we have a deferred tax opening balance of 78,400. Look at our calculation. 78,400 purple, 78,400 purple. Right. Then we credit our deferred tax liability with a 30,800, which we have identified, 30,800. Look at this, our movement. And we debit our deferred tax liability with a 3,900, a decrease. And this will result in a closing balance of 105,300. Before we move on, I just quickly want to show you guys something. Remember now that this is our current tax calculation. I've indicated to you our reconciling items will consist out of 1, our non-taxable, non-deductible, and number 2, our movement in our temporary differences. Right, now when you look at this, guys, the total of our movement in our temporary differences is this 110,000. Taxable, okay? Taxable, we credit our deferred tax liability. We debit our income tax expense in our profit and loss. Right. Now, it's a tax that we provide for to pay in future. Now, if you look at our deferred tax calculation, which I've just cleaned a bit because I know that it is extremely busy, 2021, 2022, and you look at the movement in terms of our temporary difference. Look at the profit and loss movement, taxable. And this will be the 110,000. Do you see that this agrees to your movement in your temporary difference? Yeah, your 110,000. A taxable temporary difference. Now you're going to ask me, but why do we have the bracket? Think about this. Listen, it will be a payable. Remember, this is a calculation only. It will be a payable in future, not now. Therefore, we take this out and we deduct. We decrease our profit. We are only going to pay this in future, not now. This is a calculation only.